Have you ever wondered what a stock is and how it actually works? Well, let's break it down. At its core, a stock represents ownership in a company. When you purchase a stock, you're buying a small slice of that company's assets and earnings. Think of it like a pie. The company is the whole pie, and each stock is a piece of that pie. The bigger the slice you own, the larger your claim on the company's assets and earnings. Now, where do you buy these stocks? They are bought and sold on various stock exchanges, places like the New York Stock Exchange or the Nasdaq. These are essentially marketplaces for buying and selling stocks. It's like going to a farmer's market, but instead of buying apples or oranges, you're buying pieces of companies. And the price? It fluctuates based on supply and demand, just like any other market. So when you buy a stock, you're basically buying a piece of a company. Did you know there are different types of stocks you can buy? Yes, indeed. Let's dive into the two main types: common stocks and preferred stocks. Common stocks are, well, common. This is what most people think of when they talk about investing in stocks. As a common stockholder, you usually have the right to vote at shareholders' meetings. These votes can influence the direction of the company. You're also entitled to receive dividends. That's a portion of the company's profits distributed to shareholders. On the other hand, preferred stocks are a bit different. Preferred stockholders generally don't have voting rights. But there's a trade-off. Preferred stocks have a higher claim on assets and earnings. This means if the company pays dividends, preferred stockholders get paid first. And in the unfortunate event of bankruptcy, preferred stockholders are ahead of common stockholders when assets are liquidated. So whether you want to have a say in the company's decisions or just enjoy the profits, there's a type of stock just for you. Now that you know what a stock is, you're probably wondering how you can make money from it. Well, there are two primary ways to earn from stocks: through dividends and by selling stocks for a profit. First, let's talk about dividends. These are essentially a slice of the company's earnings, which are distributed to shareholders. When a company you've invested in performs well and makes a profit, it might choose to share a piece of that pie with you in the form of a dividend. It's a way of saying thank you for your investment and faith in the company. The second way to make money from stocks is by selling them for more than you paid for them. This is known as capital gains. If you buy a stock at $10 per share and it goes up to $15 per share, you've made a profit of $5 per share when you sell. So owning stocks can be a profitable endeavor, but it's not without risks. As with any investment, investing in stocks comes with its own set of risks. It's crucial to understand that the value of stocks can fluctuate. They can rise, but they can also fall. In some unfortunate scenarios, there's even the potential to lose your entire investment. Market volatility, which refers to the speed at which the price of stocks increases or decreases, is a major player in this game of risk. It can be influenced by a myriad of factors such as political instability, natural disasters, or even social trends. Economic conditions, both domestic and global, also have a significant impact. Recession, inflation, unemployment rates, they all play a part in the health of the stock market. And let's not forget about company performance. Poor management, bad business decisions, or even a scandal can send a company's stock prices tumbling down. Remember, investing in stocks is not a guaranteed way to make money. But with proper research and planning, it can be a rewarding one. Let's recap what we've learned about stocks. Stocks are essentially pieces of a company that you can buy. They represent a claim on part of the company's assets and earnings. There are two main types of stocks: common and preferred. Common stockholders have voting rights, while preferred stockholders receive dividends before common stockholders. Making money from stocks can be achieved in two ways: through dividends and by selling the stock for more than you paid for it, known as capital appreciation. However, investing in stocks also carries risks. The value of a stock can go down as well as up, and there's no guarantee you'll get back what you invested. It's crucial to continue learning about investing and to consider your own financial goals and risk tolerance before investing in stocks. Knowledge and understanding are your best allies in the world of investing. Remember, the world of stocks is vast and intriguing, but it's important to understand what you're getting into before you dive in. Happy investing!